Trade management is another key part of our overall trade plan. Now, when we talk about trade management, we're talking about how we manage our open positions. And that is reducing risk, removing risk, and locking in profits when applicable. Now, it's important to do this in the proper way. Now, we just talked about earlier that market volatility changes from day to day and week to week. So use key levels of support and resistance to protect your stop. This is the same thing when we're placing a stop loss. We recognize that the market is dynamic, so we need to have a dynamic way to place our stops and to manage our trades. I've seen a lot of strategies out here that have a static way to move stops, managing the trades. For example, the market gets up 10 pips or the market gets up 20 pips, or your trade, excuse me, and they're bringing the stop loss to break even at that point. Okay, static ways of managing your trades don't work very well in a dynamic market simply because the volatility changes. Okay, the swing size changes. Where a 20 pip swing may be good on one day, it may not be so good the next. Okay, you might have a range of the market that is 150 to 200 pips. In that case, moving your stop when the market moves 20 pips isn't going to help you very much. You're just going to take a lot of break-even trades and miss out on a lot of profits. Key levels that we can use obviously are swing points, Fibonacci levels, price patterns, and candle patterns. And folks, don't be afraid to cut a trade loose. If the pattern changes during a trade and disqualifies, or if we see a qualified divergence setup ending our bullish run, don't be afraid to cut the trade loose. Okay, cut it loose, take your profits. But only with a solid technical reason.